news you can count on continues with Gina Glaros.
After a back-and-forth year on the stock market, what do we need to know as we're making those important financial decisions for the new year? Edison Byzyka from Hefty Wealth Partners joins us now with a lot of those answers. Great to have you here with us this morning. So a lot of talk about the market crash this year, about potential market crash. What's the market look like from a global standpoint right now?
Sure. So global markets in general seem to be mildly confused. We have this great economic run-up. We have great domestic economic numbers, especially tied to the labor market. But you have a market that's kind of experiencing a lot of volatility. So volatility in itself is not bad. I think we're just unfortunate to see here two consecutive declines in the market. But as far as a crash is concerned, I think this is merely a cyclical correction, which is much needed, as opposed to a crash which could go north of or more than negative 30%, something that we don't envision in the books whatsoever. So volatility in the near term for sure, but I don't think anywhere near terms of a crash that would cause global havoc, if you will.
So for investors, as we continue on to 2016, should we be getting out of the market?
So getting out of the market may imply some sort of market timing, and you know, no one can time the market. I think the best way to approach the markets in 2016 is by having an objective and systematic process, but definitely stay in. You know, if you have 20, 30, 40 years to be in the markets, trying to get out now and potentially miss the next leg of a secular bull market is probably not in your favor at this point.
Interest rates, what do they look like? I've heard that they're going to steadily increase.
So that's the conventional wisdom, right? There's been a lot of discussion of that. What we've seen actually since the Fed raised interest rates by 25 basis points, 0.25% in December, the 30-year average national fixed mortgage rate has actually dropped a little bit. So it's about a 3.93, 3.94% right now. So depending on what the market does here, the Federal Reserve does with interest rates in March, I think we'll see how interest rates may be guided. So right now, actually, the forecasts are for that 4%, maybe subpar 4% for interest rates for mortgages, and for the Federal Reserve to keep rates as is.
Okay.
Yeah.
As far as investing, what else should we know? Should we be more moderate in our investing?
Yeah, so this is a great time to gauge your risk assessment, right? I mean, the market has declined here in 2016 a little bit. And so gauge your risk assessment in real time, see how you feel about the markets, and always remember that a loss is never a loss until you actually sell your investments. Being invested through different market cycles doesn't actually derail your retirement or your ability to stay retired. But you know, trying to time the market and getting in and out at different times is probably more detrimental than it is beneficial to your overall investments.
Okay, great to have you here with us.
Great to be here.
And we'll have that information as well as Hefty Wealth Partners, their information. There's Edison Byzyka's email.